What if I told you that the money in your bank account isn't entirely yours to access whenever you want? Now, before you click away, this isn't a conspiracy theory. I'm not talking about a bank simply stealing your FDIC insured deposits. That's not how it works. The reality is much more complicated and is buried in the bureaucratic plumbing of the financial system. Under specific, stressful economic conditions, your ability to get immediate cash can be legally delayed or made more difficult. We're talking about a collection of real, documented regulatory tools, emergency levers that can be pulled when the entire financial system is under pressure. Right now, several stress points are flashing yellow. In this video, we'll break down exactly how these mechanisms work, why the risk is elevated right now, and what it means for the future of your money, especially if you're invested in Bitcoin. To understand how your access to cash could be restricted, we just have to look back at recent history. The 2008 financial crisis was a wake up call, but it was the chaos of March 2020 that really tested the modern system. During the pandemic's onset, there was a massive dash for cash. Panicked investors pulled billions from certain types of money market funds, which many people and corporations use, like high yield savings accounts. This selling pressure nearly broke these funds. The mere potential for these funds to impose redemption gates or liquidity fees, tools designed to stop a bank run, actually made the run worse. Investors scrambled for the exits, terrified they'd be the ones left behind, unable to get their money. The panic got so bad that the government had to step in with emergency lending facilities to prevent a complete meltdown. This isn't ancient history, it's the blueprint. Regulators learned that when confidence disappears, the rules about accessing your money can change in an instant. Their solution wasn't to get rid of these tools, but to refine them. So, what are the specific levers that could get pulled today? Let's get into the how. The reality is far more bureaucratic than outright theft, and it's built around three key mechanisms that aren't widely understood. First, and most directly, are money market fund rules. A lot of people, and especially businesses, use money market funds, MMFs, to get a better yield than a standard savings account. It's critical to understand that these are not FDIC insured bank deposits, and they operate under different SEC rules. After the scares in 2008 and 2020, the SEC reformed these rules again. Now, institutional prime and tax exempt money market funds are required to impose a mandatory liquidity fee if they see huge withdrawals in a single day. Specifically, if net redemptions exceed 5% of the fund's assets. What does this mean? If there's a panic and too many people try to pull their cash out at once, the fund is legally required to charge you an exit fee, making it expensive to get your own money. While the SEC removed the ability for funds to completely halt redemptions or gate you, this mandatory fee is a powerful deterrent designed to trap capital during a crisis. The second lever is the Federal Reserve's discount window. Think of this as the lender of last resort for banks. When a bank is short on cash to cover withdrawals, it can get an overnight loan from the Fed. On its own, this is a good thing. It gives banks the liquidity to avoid denying withdrawals. However, heavy use of the discount window is a massive red flag. It's a signal to the entire market that certain banks are in deep trouble and can't get funding elsewhere. There is a stigma associated with its use for this very reason. When this happens, regulators get extremely nervous about the stability of the whole system, which can lead them to take other emergency actions. It's not the discount window itself that freezes your account. It's the crisis that the use of the window signals. The third lever is settlement and clearing delays. Your money doesn't move instantly. When you wire funds, sell a stock, or make a big transfer, It goes through a complex plumbing system run by entities like the Fedwire or the DTCC. In a severe crisis, these settlement systems can be deliberately slowed down. We've seen these systems continue to operate during major disruptions like 9/11 and Superstorm Sandy. But in an extreme financial cascade, they are designed to be a backstop. This isn't an official gate on your account, but it has the same effect. If settlement times are extended from 1 day to three, or paused to prevent a domino effect of failures, your money is effectively frozen. You can't get it out because the back end system that moves it has been put in a medically induced coma to save the patient being the financial system. So, these emergency levers exist, but they only get pulled in a crisis. The real question is, how close are we to one? There are a few major stress points building in the system. The first and biggest is commercial real estate, CRE. The shift to remote work has hammered the office market, causing high vacancy rates and falling property values. This is a slow motion train wreck for the regional banks that hold a huge amount of these loans. A massive wave of commercial mortgages is set to mature by the end of 2026, with some estimates putting the total over $1.5 trillion. Financing this debt in a high interest rate environment will be incredibly difficult, likely leading to a wave of defaults. Banks are already extending and pretending by restructuring loans, but that can't go on forever. The second catalyst is the mountain of unrealized losses on bank balance sheets. When interest rates were near zero, banks loaded up on long term government bonds. After the Fed's historic rate hikes, the market value of those bonds plummeted. As of early 2025, US banks were still sitting on hundreds of billions in these paper losses. These losses aren't a problem, as long as banks don't have to sell the bonds. But if a CRE driven crisis forces them to sell assets to cover deposit outflows, they will have to realize those losses, which could wipe out their capital and make them insolvent. This is the exact scenario that destroyed Silicon Valley Bank in 2023. The Fed knows this. Their own stress tests are specifically designed to model a severe recession with major stress in commercial real estate, which tells you how seriously they are taking this threat. So, what does any of this have to do with Bitcoin? In a financial crisis, the first instinct is to dash for cash. But if the mechanisms we discussed get triggered, if money market funds charge exit fees and settlement systems slow down, that dash hits a wall. This is where a new danger emerges for Bitcoin investors. Here's the potential chain reaction. A crisis in the traditional banking system creates a liquidity crunch. Institutions and individuals need cash, but their money is temporarily hard to get, so they look to sell other things. One of the first assets to be sold in a panic is a highly liquid one, like a Bitcoin ETF. Imagine this on a massive scale. In a full blown liquidity crisis, you can see billions heading for the exit as everyone tries to sell their ETF shares for cash. But here's the rub: the firms that process ETF redemptions, the authorized participants, APs, are the same giant financial institutions at the heart of the crisis. Their own access to immediate cash might be restricted by MMF fees. The very settlement plumbing they rely on could be delayed. This creates a potential vicious feedback loop. ETF investors demand cash, forcing APs to sell huge amounts of actual Bitcoin on the spot market. But because the APs are themselves low on liquidity, they might be forced to sell into a crashing market with few buyers. This forced selling could trigger a price crash far greater than normal volatility. Your Bitcoin isn't confiscated, but its value could be hammered overnight. Not because of a flaw in Bitcoin itself, but because of a failure in the traditional financial plumbing that the ETFs are built upon. The Bitcoin asset might be a lifeboat, but the ETF vehicle is still tethered to the old ship. Navigating these shifts in the financial world requires understanding the deep structural risks that most people miss. If this level of analysis is valuable to you, and you want insights that go beyond the headlines, make sure you subscribe to the channel and hit the notification bell. The idea that your access to money could be restricted isn't a simple conspiracy about bail ins. It's about a series of real, legal, and complex mechanisms designed to protect the financial system as a whole, sometimes at the expense of an individual's immediate access to their cash. We have money market fund rules that can make it expensive to withdraw cash in a panic. We have the Fed's emergency lending window, where heavy use is a smoke signal for a much bigger fire. And we have the ability to slow down the entire payment system, creating a de facto freeze on your money. The catalysts for such a crisis are brewing, mainly from the stress in commercial real estate and the unrealized losses on bank balance sheets. For Bitcoin investors, the danger is subtle. A liquidity crisis in the traditional system could trigger massive, forced selling through ETF vehicles, causing a price cascade as the financial plumbing seizes up. The risk isn't that someone will take your money next week. The risk is that the system designed to move your money will be legally and deliberately paused to prevent a meltdown, leaving you locked out at the worst possible moment. Understanding this risk is the first step to truly preparing for it.